The Federal Reserve's decision to proceed with a $2.5 billion renovation of its Washington, D.C. headquarters has sparked controversy amid significant financial losses. The project, initially approved in 2021, has faced escalating costs, now 32% higher than the original estimate, due to rising building material prices. Critics, including former Fed official Andrew T. Levin, have likened the expenditure to the opulence of the Palace of Versailles, questioning the Fed's authority to undertake such a lavish project without congressional oversight. The renovation aims to modernize the Eccles and FRB East buildings with features like rooftop gardens and a new elevator system, despite the Fed's ongoing financial challenges. The Fed's financial situation remains precarious, with operating losses of $77.5 billion last year, down from $114.6 billion in 2023. These losses have contributed to a deferred asset, which the Fed must address before allocating funds to other federal priorities. Despite these financial woes, Fed officials maintain that their ability to conduct monetary policy is unaffected. However, the costly renovation has drawn scrutiny from politicians concerned about excessive government spending, especially given the Fed's current borrowing practices, which bypass congressional appropriation and are not subject to the federal debt ceiling. The situation underscores the tension between fiscal responsibility and the need for institutional modernization.
Nike, a staple in the S&P 500 index, has seen its stock plummet by 68% from its peak, largely due to strategic missteps and declining revenues. Over the past 4 fiscal quarters, Nike's revenue has consistently decreased year over year, with projections indicating a mid-teens decline for the current quarter. This downturn is attributed to a lack of product innovation and an over-reliance on classic footwear models that have lost consumer appeal. Additionally, Nike's strategic pivot during the pandemic to focus on direct-to-consumer sales at the expense of traditional retail partnerships has backfired, prompting the company to rebuild relationships with wholesale accounts. Elliott Hill, a seasoned Nike executive, was appointed CEO last October, with a mandate to refocus the brand on its core sporting ethos. Despite these challenges, Nike remains a formidable force in the sportswear industry, bolstered by its strong brand equity and strategic partnerships with major sports leagues and athletes. While sales have been under pressure, Nike's $5.3 billion in footwear sales in Q3 underscores its market dominance. However, the company must navigate additional headwinds, such as potential tariff increases that could impact costs. For investors, Nike represents a high-risk, high-reward opportunity. With its price-to-earnings ratio at a decade low, the stock could offer substantial returns if the company successfully executes its turnaround strategy. Conversely, risk-averse investors might prefer to await clear signs of recovery before committing capital.
Maravai Lifesciences Holdings, Inc., Nasdaq MRVI, is involved in a securities class action lawsuit with a significant deadline approaching on May 5, 2025, for investors to secure legal representation. The lawsuit, spearheaded by the ROSEN law firm, a leading global investor rights firm, alleges that Maravai made false or misleading statements about its financial controls and revenue recognition between August 7, 2024, and February 24, 2025. These misstatements purportedly led to an overstatement of the company's goodwill and misleading positive statements about its business prospects, resulting in investor losses once the true financial situation was disclosed. The ROSEN law firm, recognized for its success in securities class actions, including securing the largest settlement against a Chinese company, is urging investors who purchased Maravai securities during the specified period to join the class action. The firm operates on a contingency fee basis, meaning investors can participate without upfront costs. This case underscores the critical importance of accurate financial reporting and maintaining robust internal controls, as failures in these areas can significantly erode investor trust and negatively affect stock performance.
Asian economies, particularly South Korea, Japan, India, Vietnam, and Thailand, are actively pursuing interim trade agreements with the United States to avoid steep tariffs set to take effect soon. These countries, heavily reliant on exports to the U.S., face tariffs rising to 25%, with Vietnam and Thailand facing even higher rates of 46% and 36%, respectively. The urgency stems from a 90-day grace period ending in early July, during which these countries aim to negotiate smaller deals to forestall the full impact of these tariffs. Treasury Secretary Scott Bessent highlighted on ABC News that 18 U.S. trading partners are part of ongoing negotiations, with Asian countries progressing well in talks. The potential for interim agreements is significant, as they would allow these nations to maintain competitive access to the U.S. market, which is crucial for their export-driven economies. For the Trump administration, securing such deals would demonstrate the effectiveness of its assertive trade policies. Meanwhile, other global trading partners, such as those in North America and Europe, are taking a more cautious approach, weighing the risks of quick agreements against the potential benefits. In contrast, the U.S.-China trade negotiations remain stalled, with both sides entrenched in their positions, highlighting the complexity and geopolitical nuances of the current global trade landscape.
Saudi Arabia and Qatar have announced their decision to pay off Syria's $15 million debt to the World Bank, a strategic move aimed at reviving the World Bank's support for Syria after a 14-year hiatus. This decision, disclosed during the World Bank and IMF meetings in Washington, marks a significant shift towards international engagement in Syria's reconstruction efforts. The repayment is expected to facilitate the resumption of World Bank-funded projects in vital sectors, which have been stalled due to the ongoing conflict that began in 2011. As Syria grapples with the aftermath of a devastating civil war, the financial support from these Gulf nations could play a crucial role in the country's recovery and infrastructure rebuilding efforts, estimated to cost upwards of $400 billion. Following the fall of Bashar Assad's government, the geopolitical landscape in Syria has shifted, with insurgent groups like Hayat Tahrir al-Sham (HTS) taking control. Despite HTS being a U.S.-designated terrorist organization, Saudi Arabia and Qatar have emerged as key supporters of the new Syrian leadership. The U.S. has yet to formally recognize the new government, but has eased some sanctions, particularly in the energy sector. Similarly, the European Union and the UK have begun lifting specific sanctions, reflecting cautious optimism about Syria's potential stabilization and reconstruction. This financial and diplomatic support marks a pivotal moment for Syria, potentially accelerating its integration back into the international community and enabling essential development projects in the war-torn nation.
The current financial landscape for high-yield savings accounts presents a notable opportunity for savers, despite the Federal Reserve's recent rate cuts in late 2024. These cuts have caused a decline in savings interest rates from their historic highs. However, competitive rates are still available, with Lending Club offering an attractive 4.40% annual percentage yield (APY) with no minimum deposit requirement. This is significantly higher than the national average savings account rate of 0.41%, according to the Federal Deposit Insurance Corporation (FDIC). Savers seeking to maximize their returns should consider opening a high-yield savings account now, as these favorable rates may not persist. The importance of understanding the difference between APY and simple interest rates is underscored in this context. APY accounts for the effects of compounding, which can significantly enhance earnings over time. For instance, a $1,000 deposit in an account with a 4% APY would yield approximately $40.81 in interest over a year, compared to just $4.11 at the average rate of 0.41%. As such, high-yield savings accounts are a strategic tool for individuals looking to optimize their savings growth, particularly in a fluctuating interest rate environment.
Market volatility has intensified concerns among retirees and those nearing retirement, as President Donald Trump's trade policies continue to unsettle financial markets. With the ongoing trade war, many are apprehensive about the impact on their retirement savings, leading financial advisors to recommend cautious adjustments rather than drastic changes to investment portfolios. The uncertainty has heightened fears of outliving savings, particularly for older investors who are more vulnerable to market downturns. This sentiment underscores the broader anxiety affecting consumer confidence and spending, as individuals reassess their financial strategies in light of potential economic instability. In the realm of energy and environmental policy, President Trump's administration is making significant strides to revive the coal industry, a sector in long-term decline. Executive orders have been issued to permit mining on federal land and extend the operational life of aging coal-fired power plants. However, these measures have sparked debate, with critics arguing that they offer only temporary relief to an industry facing structural challenges. In West Virginia, a state heavily reliant on coal mining, these initiatives have been met with mixed reactions, reflecting both optimism and skepticism about the industry's future viability. The broader implications of such policy shifts could influence energy markets and regulatory landscapes, affecting both domestic and international environmental commitments.
JP Morgan has upgraded its outlook on the Philippine stock market, raising its rating from neutral to overweight, signaling confidence in the country's economic resilience amid global trade tensions. The bank's securities arm highlights the Philippines as a potential refuge for investors, given its largely domestic-oriented economy, which is less vulnerable to international trade disruptions. As part of this optimistic stance, JP Morgan has identified Manila Electric Company, Meralco, Globe Telecom, BDO Unibank, and Bank of the Philippine Islands, BPI, as top stock picks, each poised to benefit from robust domestic consumption and favorable economic conditions. The report underscores the Philippines' macroeconomic strengths, such as a consumption-driven economy and a relatively low dependency on exports, which could bolster corporate earnings even during a global slowdown. Additionally, the country is expected to attract substantial foreign direct investment, FDI, due to its competitive labor costs and lower U.S. tariff levels compared to other Southeast Asian nations. However, challenges such as high energy costs and regulatory barriers remain. JP Morgan also notes that the monetary policy environment is supportive, with expectations of multiple interest rate cuts this year, potentially enhancing market attractiveness and preventing further market devaluation.
The Philippine economy is facing increased pressure from a surge of inexpensive Chinese imports amid ongoing global trade tensions, particularly due to the U.S.-China tariff war under President Trump's administration. According to a report by Japanese investment bank Nomura, the influx of Chinese goods into the Philippines has intensified competition for local manufacturers, particularly in sectors such as basic metals, machinery, and furniture. This trend is exacerbated by Trump's recent imposition of a 17% tariff on Filipino goods entering the U.S., although a temporary 90-day pause has been announced. Nomura's chief ASEAN economist, Euban Paracuelas, highlights that the rise in Chinese imports could lead to disinflation in the Philippines, potentially allowing the Bangko Sentral ng Pilipinas to cut interest rates to bolster the economy. As the U.S.-China trade war persists, the Philippine government is urged to enhance spending and implement reforms to strengthen the local manufacturing sector. This includes diversifying the manufacturing base and reducing operational costs to improve competitiveness. Such measures are crucial in mitigating the adverse impacts of increased import penetration and ensuring the resilience of the domestic economy.
CIMB Bank Philippines recently faced a significant challenge involving unauthorized transactions reported by its customers, with some accounts experiencing fund transfers amounting to 500,000 pesos. Over the weekend, the digital-only bank took swift action by shutting down its banking services to conduct a comprehensive system check. By Sunday afternoon, CIMB assured the public that all affected customers had been reimbursed and emphasized that its core banking system remained secure and uncompromised. Despite the resolution, the bank did not disclose the root cause of the incident, which has raised concerns about the robustness of digital banking security. The Bangko Sentral ng Pilipinas (BSP) has stepped in, closely coordinating with CIMB to ensure the issue is fully resolved, and will continue monitoring the situation. This event highlights the vulnerabilities and challenges faced by digital-only banks, which rely heavily on technology to deliver services. CIMB Bank Philippines, part of the Malaysia-based CIMB Group, has been experiencing robust growth, with its deposit base reaching 33.64 billion pesos and a loan portfolio of 20.45 billion as of 2024. The bank's rapid expansion, marked by a 45% growth in profit before tax and a customer base nearing 10 million, underscores the need for reinforced cybersecurity measures to maintain consumer trust and sustain its growth trajectory.